All right, traders, with me today is actually Marc Chandler. And Marc, how are you doing? It's great to have you back here.
It's always a pleasure to see you. Thanks.
And Marc, I always mispronounce Bannockburn Forex. Is that correct?
Bannockburn. I think it's the last time the Scots won a battle. And our founder was really inspired by that. So, and who knows, there could be another Scottish battle coming up with if they continue to pursue a referendum for independence.
There we go. You know what? I wasn't even planning on saying that and planning with your comeback, but that's awesome. I wasn't even thinking about it. So Marc, the reason why I wanted to chat with you today is actually the reaction that we've seen in the currency market and actually equities too over the last couple of days with some of this elevated inflationary data. What do you make of it?
Well, so yeah, of course, I think everybody's talking. There's two things, right? People are either talking about jobs or inflation. And we had that big jobs disappointment. And now we had the big inflation upside surprise. And I think that yesterday to me was an important day, how the market responded to the CPI. And I know that today's PPI was also well above expectations, almost like double what people were looking for. But one of the things I've learned in the markets is that the markets typically don't let the same dog bite it twice. That is, yesterday was the climatic kind of response. The market, I think, was saying that, yes, we've heard a number of Fed officials say it's too early to begin talking about tapering. And to me, the fact that the bond market sold off, that is, yields rose, even though the stock market was getting slammed, tells me that maybe we're beginning to see the first signs of the bond vigilantes pushing back against this, what appears to be a dovish Fed.
That's interesting because you talk about the bond vigilantes, and that's something that's a term that hasn't been used a whole lot in recent years, but you are starting to see yields rise. And I was looking at the boons yesterday as well, and boons have actually broke a pretty long-term multi-year trend line as well. So how are you going to interpret this rise in yields, and how's that going to affect the markets moving forward, do you think?
Yeah, so I do think that, I think most of us think about interest rates and currencies and almost in a very linear fashion, like higher interest rates should be good for a currency. Right. It seems intuitively makes sense. But if that was really true, we probably would never have had emerging market crises. High interest rates in Turkey, 19%, and it hasn't done anything for the Turkish lira. But I do think that, so for me, the relationship is cyclical, but where we are now in the cycle is I'm seeing how the euro and the yen, not the dollar yen, but just looking at the yen like they would in the futures market, those seem to be tracking to me very closely the December 2022 euro dollar futures contract. And that is one way we could sort of tease out market expectations for a Fed rate hike. The Fed funds futures too thinly traded that far out. So I look at the euro dollars, and we saw a big jump, as if the market was telling us previously, say in the first quarter, the market was telling us that the Federal Reserve tells us they're not going to raise rates till after 2023, but we, the market collectively, thought they would do it by the end of 2022.
Right.
After that disappointing jobs data, the markets pushed it back into 2023, still earlier than the Fed says. So, but to me, to your point about the bunds, I think is very fair, because today European bond yields, not only in Germany but Italy as well, and throughout the whole eurozone, are at highs for the year. And this is after the ECB is pushing and saying we've stepped up our bond buying. But so I look at, for me, I know there's a big debate among economist types about which interest rates to look at. In this current environment, I'm watching the short end rates, and I see that the US two-year differential with Germany, 2-year differential with Japan has really narrowed. That is, the US seem to be, I think, behind the curve. We know that Norway, I know it's not a major currency, but it's sort of a tell, I think. Norway said they're going to raise rates by the end of this year. Canada, a couple of weeks ago, said they're going to taper and that they're going to use up the economic slack by the middle of next year, which we in the market knows when they use up their economic slack, that's the window of opportunity for a rate hike. Same thing with the Bank of England. Last week, they said they will slow down their bond buying. And looking at the short sterling, that's like the equivalent of the euro dollar, right? The time deposit futures contract. And it's pricing in a Bank of England rate hike by the end of next year. So to me, sometimes the dollar is the driver, and sometimes the dollar sits at like the fulcrum of a seesaw. And that's what I think it's doing now. On the top side of the seesaw, the strong currencies are those that are going to tighten the head of the Fed: Norway, Canada, the UK, perhaps even Australia. And currencies that are underperforming tend to be those that are going to be behind the curve: Japan, Switzerland, and the eurozone is sort of in between. I think that euro is most interesting to me because it's sort of like the uncola to the dollar's Coke, right? That when things are moving out of the dollar, the euro is the second biggest currency, could absorb a lot of those flows.
Sure.
And yet, you know, as we were talking, the yields in Europe are higher. And so what's going to happen at the ECB meeting next month? Previously, it looked like the hawks were pushing back. They said, look, we've accelerated our bond buying. Now we want to slow it down again. But with this new hike in yields, maybe the ECB can't quite taper so soon.
Well, that's going to be interesting because everybody is looking forward to next month's ECB and FOMC. So if you think the ECB might not be able to signal tapering, but the FOMC decides that they need to get ahead of the curve a little bit, couldn't that be more dollar bullish moving into this next month?
Yeah, no, I think you're right. If the Federal Reserve were to change its tune,
Yeah.
I just think that I think that the weak jobs data probably emboldens the Fed's leadership. And by the Fed's leadership, I mean the board of governors versus the regional presidents. The regional presidents have, they rise through the hierarchy in a different way. They tend to be business people, as opposed to who we would get on the board of governors. And so I've watched the Fed's leadership, and I still don't see any sign of their wavering. I think that it's complicated because, last year the Fed says we're going to adopt an average inflation target. It sounds very cool, but what does it really mean? What does an average mean if they don't tell us the period of time they're going to use? Exactly. And I think that what they've done is I think that oftentimes officials don't do anything unless they have to, and they want to preserve as much room to maneuver to respond to this new incoming data, so the maximum flexibility. And so I think that the Fed does not want to get sucked into raising rates too early, or tightening or tapering too early. And I think that's important. I keep making a distinction between tapering and a rate hike. Tapering is just slowing down the accommodation that they're providing. But the Fed knows that the market knows that as soon as they say we're going to taper at a certain date, people like us will figure out what's the average time between the tapering and the first rate hike, and we'll begin pricing in a rate hike before the Fed wants to do it. And so I think the Fed has sort of in this maximum flexibility and strategic ambiguity. It's really getting this push back against it. How can they? We've got in the U.S. Previously people were talking about targeting nominal GDP, your GDP plus inflation. And so if you give me a 3% growth, which is a nice target, 2% inflation, look at nominal growth, 5 to 6%. Well, in Q1, nominal growth was more than 10%. And it's likely to be more than 10% in this quarter. We've got a huge fiscal stimulus still working its way through the system. The vaccination rollout has been fairly successful. It was a slow start, fairly successful. Now we see signs of all these signs of reopening. So we've got the reopening, pent-up consumer demand, and the Fed insists that its foot still needs to be all the way to the metal on the monetary accelerator. And I think that the market's not sure about that. That is to say, the market might be beginning to price in a policy mistake. It's not so much that the Fed should raise interest rates. It's just that it doesn't need its accelerator all the way to the floor.
That's interesting. And one of the things you didn't mention, Mark, and then I'll let you go and wrap this up, is how about taxes moving forward? I mean, does it seem to the market increasingly less likely that we're going to get much in tax hikes from the Biden administration?
Yeah, isn't that the way the sort of Solomon type of compromise in the U.S.? Instead of the Democrats getting new spending and tax hikes, the compromise is new spending, no tax hikes. I think that that in the U.S. it's not so much. I know we all caught up in this partisanship between Republicans and Democrats. It's not the real story. The real story is the split within the Democrats. If Biden could hold all the Democrats in the Senate, he will get what he wants. The problem is that there's a difference between the Democrats in the Senate, and the moderates are the ones who are really preventing both this big tax increase. But again, the tax increase isn't to, I mean, I don't know, my boss has done a really good job of making sure that I don't meet any kind of threshold for tax increases, right? And most of our bosses are doing the same thing. Who does it really hit? It's going to hit people with very large incomes. And by large incomes, the median family in the US has an average household income about $65,000. We're talking about taxing people who have 4 or 5 times that. And so I do think that the capital gains tax is interesting. I'm reminded earlier in my career when Ronald Reagan raised the capital gains tax. And I'm afraid that these days, I thought Ronald Reagan was a conservative president. I'm afraid that he's too liberal to become president here in the early 2020s.
Isn't that the truth? well, Marc, hey, I want to thank you for your time. Your insights are always so valuable to our community. And I look forward to talking with you again in the very near future.
Thanks. Good luck to everybody.
All right. Thank you.